Imagine you have $100,000 to invest. Do you buy a house or do you buy farmland? At first, the house seems obvious. You can rent it out, collect monthly income, and maybe watch the property go up in value. But farmland has its own appeal. It can produce lease income, appreciate over time, and may come with fewer daily headaches than a rental property. So the real question is not just, which one sounds better? The real question is, which one puts more money in your pocket? In this video, we're going to compare both using realistic numbers, not fantasy returns. Let's start with the house. In this example, imagine buying a $300,000 rental property. You put $60,000 down and use a mortgage for the rest. Now let's say the property rents for $2,300 per month. That sounds like a lot of money coming in, but rent is not profit. From that rent, you still have to pay the mortgage, property taxes, insurance, repairs, and money for vacancy or property management. In this example, the mortgage payment is about $1,475 per month. Property taxes are around $250. Insurance is around $150. Repairs and maintenance might average around $200. And vacancy or management reserve could be another $200. So total monthly expenses are about $2,275. That means the monthly cash flow is only about $25 per month. So yes, the house is making money, but the monthly cash flow is very thin. That is the part many new investors miss. A rental house can build wealth, but it does not always put a lot of cash in your pocket right away. Now let's look at farmland. Instead of renting a house to a tenant, you may lease the land to a farmer. The farmer uses the land to grow crops, and you collect lease income. In this example, suppose you buy $100,000 worth of farmland. A realistic gross annual lease income might be around $205,000 to $4,000 per year. That equals about $208 to $333 per month before expenses. But just like with the house, gross income is not profit. You may still have taxes, fees, and upkeep. If those costs are around $500 to $1,000 per year, then your net income might be closer to $1,500 to $300 per year. That works out to about $125 to $292 per month. So farmland may not create huge monthly income, but it can be steadier and require less daily management. There are no tenants calling about broken toilets, no appliances to replace, and no bedrooms to repaint after someone moves out. But farmland has a big warning. Location matters. The income depends on soil quality, water access, crop demand, local farmers, lease terms, and the strength of the agricultural market in that area. Good land can be valuable. Bad land can sit for years. Now let's compare them head to head. First, cash flow. For a house, cash flow is deal dependent. A great rental can produce strong income, but a weak rental can barely break even. For farmland, the cash flow is usually lower, but it may be steadier if you have a good lease with a reliable farmer. Second, maintenance. This is where farmland often has an advantage. A house has more things that can break: the roof, plumbing, heating system, appliances, flooring, paint, and more. Farmland may still have costs, but the daily maintenance is usually lower, especially if the land is leased properly. Third, financing. Here, the house usually wins. It is generally easier for everyday investors to get a residential mortgage than to finance farmland. That mortgage also gives the house one of its biggest advantages: leverage. With a house, you might use $60,000 to control a $300,000 property. With farmland, many small investors may need more cash up front. Fourth, liquidity. Again, the house usually wins. More people are looking to buy houses than farmland. If you need to sell quickly, a house usually has a larger buyer pool. Farmland can sell well too, but the buyers are more specialized: farmers, land investors, or developers. Fifth, appreciation. Both are location dependent. A house may go up in value if it is near jobs, schools, population growth, and strong housing demand. Farmland may go up in value if it has productive soil, good water access, strong local farming demand, or future development potential. So appreciation is not guaranteed for either one. The deal and location matter. Now let's look at the possible 10-year outcome. For the house, the starting cash might be $60,000 as a down payment. Because the house uses a mortgage, you control a larger asset. Over 10 years, the property may appreciate, the tenant may help pay down the mortgage, and you may collect some cash flow. Depending on the market, interest rates, expenses, rent growth, and property management, a possible 10-year outcome could be around $180,000 to $240,000 in equity plus cash flow. But this is important. That is not pure profit. It includes the value of your equity position and depends on the remaining mortgage balance, the property value, and the income earned over time. Now compare that with farmland. For farmland, the starting cash in this example is $100,000. If the land appreciates and produces rent over time, a possible 10-year outcome might be around $150,000 to $200,000 in land value plus rent. Again, that is not pure profit. It is an estimated value plus income range, and it depends on land productivity, rental demand, market conditions, and expenses. The key difference is this: the house example uses leverage. The farmland example uses cash. Leverage can make the house look more powerful because you control a bigger asset with less money down. But leverage also increases risk. If the house sits vacant, expenses rise, or the property value falls, the mortgage still has to be paid. Farmland may grow slower, but it may also be simpler to hold if you bought it without debt. So which one brings more money to your pocket? For most beginners, a house is usually easier to finance, easier to understand, and easier to sell. It also gives you leverage, which can boost returns over time. But houses come with more tenant issues, more repairs, and cash flow that may be much thinner than expected. Farmland may be better for patient long-term investors who want lower daily management, a tangible asset, modest lease income, and long-term land value. But farmland can be harder to finance, harder to sell, and very dependent on location. So the final answer is this: for beginners, the house may be easier. For patient long-term investors, farmland can be attractive. But the real winner is not always the house or the farmland. The real winner is the better deal. A bad house can lose money. Bad land can sit for years. But the right property, in the right location, bought at the right price, can build real wealth over time. The deal and location matter more than the asset.